Imagine two investors. One buys because everyone else is buying. The other buys because evidence supports the decision. This fundamental difference determines their destiny. One sells because panic is spreading, reacting to the noise of the crowd. The other sells because their plan says it's time, acting with the precision of a professional. Over a lifetime of investing, these two people often achieve very different results. One builds a legacy, the other chases shadows. Today, we bridge that gap. Why? Because markets are not just numbers. They are driven by primal human emotions: fear, greed, hope, panic, euphoria. These forces move billions every day. Understanding these emotions can give investors a powerful advantage. Today, you'll learn how market sentiment works, how professionals measure it, and how you can master it, and why understanding crowd psychology may be just as important as understanding technical charts. Welcome to episode 22. Let's begin the journey. Market sentiment is the overall mood of investors. It is the collective temperature of the marketplace, how people feel about markets, not necessarily what they know. It's not always about what is true or factual. It's about perception. Sometimes investors become optimistic, blinded by the promise of easy gains. They believe prices will rise forever. Other times they become fearful, expecting catastrophic declines. These collective emotions influence buying and selling behavior, and that behavior, in turn, influences the prices you see. The market is not simply a cold machine or a set of algorithms. It is a reflection of human psychology. To understand the chart, you must first understand the human. Many emotions exist in the spectrum of trading, but two dominate the financial world above all others: fear and greed. They are the engines of the market cycle. Greed appears when investors believe opportunities are everywhere. Prices rise, confidence grows, risk-taking increases. Investors begin to believe they can't lose. Eventually, some investors begin ignoring reality entirely. They chase the high, forgetting the fundamental laws of gravity. This is where euphoria takes over and reason vanishes. Fear appears when uncertainty increases. Prices begin to wobble, then fall. Confidence disappears instantly. Investors seek safety, often abandoning their well-laid plans in panic. Sometimes fear becomes excessive, driving prices far below their actual value. Just as greed can become excessive, understanding these emotional extremes is the key to market mastery. This may sound surprising to some, but the crowd is often most confident near market tops and most fearful near market bottoms. Why? Because emotions become amplified at the edges. During major bull markets, investors begin believing prices can only go higher. The fear of missing out overrides the fear of loss. During major bear markets, the opposite happens. History repeatedly shows that extreme optimism and extreme pessimism often occur near important turning points. Professional investors understand this. They pay attention to the fever, because extremes often create opportunity. When everyone is running for the exit, the professional is looking for the entry. This requires a level of discipline that few possess. Markets often follow a psychological cycle. It starts with optimism, builds into excitement, then thrill, and finally euphoria. This is where the danger is at its absolute peak. Then reality appears. Anxiety turns into denial, which quickly shifts into fear and panic. Finally, we reach capitulation, the point where many investors finally give up. Eventually, recovery begins. The cycle repeats. Different companies, different generations, different technologies, the same emotions, because human psychology remains constant over time. Understanding this cycle helps investors recognize the emotional environments they are in. And emotional environments influence every decision you make. Awareness is your shield. Professionals do not rely only on feelings. They measure sentiment with precision. They look for the data behind the emotion to find the truth. Some tools include investor surveys, volatility indices like the VIX, and options activity. They analyze fund flows and news sentiment. They even track social media trends for outliers. The goal is not predicting the future. No one can do that. The goal is understanding current psychology, because understanding psychology provides the context needed for better choices. Today's investors have access to more information than ever before. But information creates a new challenge, the challenge of noise. Decisions are made in seconds. Opinions spread instantly. Excitement spreads instantly. Fear spreads instantly. A single viral story can influence millions of people within hours, regardless of its accuracy. This is why professional investors remain cautious. They ask, is this information or is this emotion? The ability to separate facts from feelings has become their most valuable asset. In a world of constant noise, clarity is a competitive advantage. Pros filter the crowd's shouting to hear the market's heartbeat. They don't react, they reflect. Some successful investors develop what is called a contrarian mindset. This does not mean always doing the opposite of the crowd. That would be foolish and dangerous. It means questioning consensus. When everyone is optimistic, they ask, what risks are being ignored? When everyone is fearful, they ask, what opportunities are being overlooked? Contrarian thinking requires discipline, patience, and independent analysis, because the crowd is not always wrong, but the crowd is often emotional, and that is where the edge lies. They wait for the moments when the crowd's logic breaks down under the weight of its own emotion. That is the contrarian's harvest time. They stand alone, but they stand firm. The biggest mistake is confusing sentiment with analysis. Many investors buy because everyone is excited, or sell because everyone is afraid. They are following the mood, not the math. Professional investors seek evidence first. Sentiment matters as context, but it is not a signal on its own. It must be combined with fundamentals, technical analysis, and risk management. Evidence is the foundation of every trade. Without it, you are just gambling on the crowd's next move. Professionals build their case brick by brick, using facts as their mortar. One of the most famous investing quotes comes from Warren Buffett. Be fearful when others are greedy, and greedy when others are fearful. It sounds simple, but it is the hardest skill to learn. This idea does not mean blindly buying during every decline. It means recognizing emotional extremes and remaining rational when others lose their heads. It is the core of value investing. Remaining rational while the world panics is the ultimate edge. It is a skill developed over decades of observation and the ironclad discipline to stick to one's principles. Professionals understand that markets are driven by people, and people are emotional. Instead of fighting this reality, they study it like a scientist studies a lab. They observe behavior, monitor sentiment, and remain aware of crowd psychology. But they continue making decisions based on evidence, not emotion. That balance creates their advantage. The professional mindset is a delicate balance of observation and action. They see the fear, they feel the greed, but they never let it touch the steering wheel of their strategy. The biggest lesson is simple. Markets move because people move. People buy, people sell, people become optimistic, and people become fearful. The chart is just a mirror of us. Understanding those emotions helps investors understand the engine of the market. Those who master psychology gain insights that technical charts alone can never provide. Insight is the true wealth. When you understand why others are acting, you can choose how you will act. That choice is the difference between being part of the crowd and leading it. Master yourself, and you master the market. Choose 3 major market events from history. Research what investors were feeling and what the headlines were saying. Look for the emotional extremes that occurred. Begin training yourself to recognize sentiment, not just prices. Notice when the news is too bright or too dark. That awareness is your first step to professional level thinking. Today you learned how fear and greed influence financial markets. Tomorrow we explore one of the most important concepts in all of investing, valuation, the math behind the money. Even with a plan, the human mind is full of traps. 2 of the most dangerous are sunk cost fallacy and loss aversion. They can paralyze even the best investors. Even with a plan, the human mind is full of traps. 2 of the most dangerous are sunk cost fallacy and loss aversion. They can paralyze even the best investors. Sunk cost makes us hold on to losing positions just because we've already invested time or money. We hope for a recovery that may never come, ignoring the reality of the chart. The media doesn't just report sentiment, it often amplifies it. Headlines are designed for clicks and views, which usually means focusing on extreme fear or extreme greed. When the news is overwhelmingly positive, the public feels safe. When it is negative, they feel doomed. Professionals treat the news as another sentiment indicator, not as gospel truth. To see sentiment in action, we must look back. The late 90s saw the dot-com bubble, a time of pure euphoria, where any company with a dot-com in its name skyrocketed. Valuations didn't matter, profit didn't matter, only the dream of a new era mattered. When the sentiment shifted, the crash was swift and devastating. Greed met its match. In 2008, the world saw the opposite extreme. Pure, unadulterated fear. The housing market collapse triggered a global panic that made people doubt the entire financial system. Fear was so high that even great companies were sold at deep discounts. For the emotional investor, it was a tragedy. For the rational professional, it was the opportunity of a lifetime. More recently, the cryptocurrency market has become a masterclass in sentiment. We see cycles of 1,000% gains followed by 80% drops, driven by the purest form of crowd psychology. Social media influencers and community hype create an environment where sentiment moves faster than ever. It is the ultimate testing ground for an investor's emotional discipline. You can build your own sentiment dashboard. Start by tracking the things the crowd ignores. Look at volume, price action, and the tone of the conversations around you. When the data says steady, but the crowd says panic, you have a divergence. Divergences are where the professional's edge is found. Learn to trust your data over your gut. The hardest person to manage in the market is yourself. You are not immune to fear and greed. The key is not to eliminate them, but to recognize them when they arise. Sentiment varies by time frame. Short-term sentiment is noisy and erratic, while long-term sentiment follows the larger economic tides. Know which one you are trading. Sentiment varies by time frame. Short-term sentiment is noisy and erratic, while long-term sentiment follows the larger economic tides. Know which one you are trading. The day trader lives in the noise. The long-term investor lives in the trend. Understanding the difference prevents you from getting caught in a storm that doesn't matter for your journey. A plan is your map through the emotional fog of the market. Without it, you are a leaf in the wind. With it, you are the captain of your own financial ship. Your plan should tell you when to enter, when to exit, and how much to risk. If it doesn't, it's not a plan, it's a hope. And hope is not a strategy in the world of finance. We have covered the heart of the market, sentiment. You now know that markets are human, that fear and greed drive cycles, and that professionals use data to stay rational. Your action step for today is simple but profound. Observe. Watch the markets today not for prices, but for the mood. Hear the fear, feel the greed, and then choose to follow the evidence. One of the most effective ways to manage sentiment is to keep a journal, not just for your trades, but for your feelings during those trades. Awareness is documented progress. Record when you feel the urge to follow the crowd. Write down the fear you feel during a dip. Over time, you will see your own patterns emerge, and you can begin to master them. In the modern market, algorithms also react to sentiment. They can scan millions of news articles and social media posts in milliseconds, identifying shifts before humans can react. This algorithmic sentiment can create fast, sharp movements. As an investor, understanding that machines are also participating in the mood of the market helps you stay calm during volatility. Sentiment is global. Geopolitical events, elections, conflicts, and trade deals can shift the sentiment of entire nations in an instant. The global mood is the ocean we all swim in. Learn to separate local noise from global sentiment shifts. A world that feels safe invests for the long term. A world that feels uncertain seeks immediate safety. Know the tide. Sentiment also moves in generations. The way people feel about markets is often shaped by the events they witnessed in their youth. Every generation has its own financial scars. Those who lived through the Great Depression remained cautious for decades. Those who saw the 2010s bull run may be more aggressive. Understanding generational sentiment helps you see the big picture. Ultimately, mastering sentiment is about more than just profit. It's about building a legacy. A legacy built on rational decisions and emotional discipline stands the test of time. You are building for your future and the future of those you care about. By mastering the market's mood, you are taking control of your financial destiny. This is the professional way. Compounding is often discussed in terms of money, but sentiment also compounds. Success breeds confidence, which can lead to overconfidence if not managed. Failure breeds caution. The professional understands that their emotional state today is the result of their trades over the last month. They consciously reset their sentiment to zero before every new trade. Institutions spend millions to track sentiment. They use satellite imagery, credit card data, and advanced linguistics. But their biggest advantage is their lack of individual emotion. They operate by committee and code. To compete, you must develop your own internal committee of logic that can overrule your emotional impulses. Become your own institution. As AI and neural networks take over more of the market, the sentiment of the market is becoming more mathematical, but the source remains human. Humans program the bots. The bots reflect the biases and fears of their creators, just at a faster scale. Understanding the human root of the machine's behavior is the next frontier of market sentiment analysis. We have come a long way. You have seen how fear and greed move markets, how history repeats, and how professionals use data to stay in control. The market is a mirror. When you look at the market, you are looking at the collective soul of humanity. To master the market, you must first master yourself. That is the ultimate secret of the 1%. This was episode 22. You are now more prepared than 90% of retail investors. But knowledge without action is just trivia. Apply what you learned. Watch the mood. Trust the data. In the next episode, we dive into valuation. We'll show you how to find the real price of a business, so you never have to guess again. The path to mastery continues. I'll see you there. Herd mentality is the biological drive to follow the group. In nature, it's for survival. In the market, it's often the path to financial ruin. The professional fights this instinct every day. Standing alone is uncomfortable, but the greatest profits are found where the crowd is absent. Learn to find comfort in being different. If everyone is doing it, the opportunity is likely already gone. Confirmation bias makes us seek out information that agrees with our existing views. If you are bullish, you only see the good news. This creates a dangerous blind spot in your analysis. The professional investor actively looks for reasons why they might be wrong. They seek out the bear case even when they are bullish. Testing your own ideas is the hallmark of mastery. Recency bias makes us believe that what happened yesterday will happen today. If the market has been up for a week, we think it will be up forever. This leads to overextension at the peak. Zoom out. Look at the years, not the days. Recency is a trap for the emotional mind. The professional looks at decades of history to find the recurring patterns of human behavior. Emotion has a literal cost. Every emotional trade is a tax on your future wealth. Over a lifetime, these costs can add up to millions in lost opportunity and compounding gains. Think of your discipline as an asset. Every time you stay rational during a panic, you are making a deposit into your future. Every time you follow the crowd, you are taking a withdrawal. The path to market mastery is a lifelong journey. It is not a sprint, it is a marathon of self-control. You are now equipped with the fundamental tools of sentiment analysis. Go forth with a clear mind and a steady hand. Master the mood, follow the evidence, and build your legacy. This is Wealth Entertainment 21. We will see you in episode 23. Mastery awaits.